Well, good morning, good afternoon, and good evening, everybody, and welcome to the session on future frontiers in tax transparency. My name is Philip Curves, and I'm co-head of the Tax Treaties and International Cooperation Unit, which is the unit in the Center of Tax Policy and Administration that supports the work on tax transparency within the OECD. And I will be joined by Paul Hondius, who I see is there. Paul is the head of the harmful tax practices unit, but has also been a consistent help in our work on tax transparency. Many of you probably know some of the work, and particularly on the international standards for exchange of information, the standards that are also monitored and peer-reviewed in the Global Forum. But at the OECD, we do also other work on tax transparency, both on the policy side and the administration side. And the focus of this session is to share with you what is in the pipeline in this area, focusing a bit more on these areas that are not related to the known international standards. Because we think that some of this work may also be of particular interest to the developing countries. And if I can have the next slide, please. So before we dig into the future, maybe it's also good to take stock of the past. And if we look at the past, in the past 2 decades, I believe we have made tremendous progress in the area of tax transparency. The focus of that work has initially been on individuals and on combating tax evasion, starting in 2009 with the adoption of the International Standard of Exchange of Information upon request. Under that standard, tax authorities are expected to provide information upon request of tax authorities of other countries if that information is foreseeably relevant for the administration and the enforcement of their taxes. And of course, this standard is well known, well established, peer reviewed by the Global Forum, where we now have 171 members who all apply this standard. And of course, there is one perhaps a big limitation connected to this standard, which is that you can only ask for information if you already have some suspicion that there is a concern of non-compliance. The on-request standard does not allow for fishing expeditions, and it is for that reason that there has also been a big interest in 2012, 2013 in developing a standard for the automatic exchange of information. That standard was adopted in 2014 initially, and under that standard, countries are expected to collect information from their financial institutions on foreign account holders and share that on a yearly basis with tax authorities of the countries of residence of the account holders. The CRS is also well on its way. It was adopted initially 2014. It has already had a first review in 2023, and we have more than 110 jurisdictions that are exchanging under the common reporting standard. We then had more recently, a couple of years ago, building on the architecture of the CRS, we developed an automatic exchange framework for income derived from digital platforms. We will come back to that later. And more recently, we have had, of course, we adopted the CARF in 2023, which has been integrated into the international standard for automatic exchange of information and tries to fill the gap created by the fact that the common reporting standard developed in a time where crypto was almost non-existent, did not cover comprehensively the crypto assets. The CARF is also well on its way. We have now, I think, 67 jurisdictions that have committed to start to implement the CARF and to start exchanging into 27 or 28, and already approximately 50 jurisdictions that have signed up to the CARF MCAA. Then, of course, our focus has not only been on individuals, and if we can move to the next slide, we have also rolled out a whole series of transparency initiatives that are focused on business taxation, and in particular in the context of BEPS. This came a bit after the adoption of the Common Reporting Standard. There's, of course, in 2015, we adopted the country-by-country reporting, or the automatic exchange of country-by-country reports, as part of BEPS Action 13. And as a result of that, tax authorities receive information on large M&E groups with operations in their country, breaking down the group's revenue, profits, tax, and other attributes per jurisdiction. This has also been successfully implemented, with currently 120 jurisdictions that have implemented CBC reporting obligations that covers almost all M&Es that could be in scope of country-by-country reporting, and we have now more than 4,000 exchange relationships between almost 100 IF jurisdictions to exchange country-by-country information. Also in 2015, as part of BEPS Action 5, we adopted the spontaneous exchange of information on taxpayer-specific rulings, information in the absence of which there could be concerns of BEPS or profit shifting, base erosion. And since the adoption of this BEPS Action 5, since the start, we now see that information has been exchanged about more than 58,000 rulings, and approximately 5,000 last year. We also more recently, I think this was 2018, 2019, we adopted the spontaneous exchange of information to support compliance with the substance requirement for entities in no or nominal jurisdictions, also entirely rolled out. All no nominal jurisdictions participate in this exchange framework, and 30 jurisdictions have expressed or have opted to receive information under this framework. And then, almost fresh from the press, earlier this year in January, we have finalized the exchange framework for the automatic exchange of GLOBE information, and this is meant to support the administration of the GLOBE rules. And we will soon move into signing of the GLOBE or the GIR MCA, the Multilateral Competent Authority Agreement for the automatic exchange of GLOBE information. As you can see, we have had a whole host of initiatives, both on the side of individual taxation and on the side of business taxation. But this is the past. I think we also need to think about the future. And if we can maybe look at the next slides, we can get the next slide. Here we would like to share with you what we see as the focus of current work and future work in the space of tax transparency. And we see 3 areas of priority, some of which are already ongoing and some of which are perhaps a bit more long-term. We have made, as you can see from the previous slides, we have made a lot of progress in the area of tax transparency in connection with financial assets and crypto assets, to the extent that they could not be labeled as financial assets. But we have made less progress in beyond financial assets, and since recently we have focused more on tax transparency in the area of real estate, immovable property, and Paul will talk about a bit more about that later. Our second area of priority that we see is maybe not entirely new. This relates to the automatic exchange framework we developed for income derived from digital platforms. This has already been adopted, but we think that there is still potential to widen the participation in this framework, because we believe that for many countries it could be very beneficial to participate in this framework. And then last but not least, we see also a lot of interest in maybe instead of adding on new frameworks and more transparency, in trying to improve the existing standards and the transparency that exists by making use of new technology. And that's an area of focus also in the forum on tax administration, and we will come back to that later. But on that note, I would like to hand over to Paul, who will talk about our work on real estate.
Thank you very much, Philip, and also from my side, a good day to everyone joining this session. I hope it is interesting and useful to you to get a bit of an idea of the different areas of policy that we're currently working on, and certainly one of the very important areas that we're currently undertaking work on is the area of real estate. As Philip has already said, real estate is arguably one of the most attractive non-financial asset classes for people to invest their money in. And of course, it is very possible to not only do that at home in your own country, but to also do so abroad and acquire real estate in other countries. And of course, there are certain tax challenges that stem from that because of obviously the limits of governmental influence to their own sovereignty, and therefore it is of course important to look into options for international cooperation and coordination in this area. So maybe to start the overview of the work that we currently have ongoing on real estate with a very straightforward question. Why does this matter? What is the reason or what are the reasons that we are undertaking this work? I think here on this slide, apart from the fact that you see many houses on different parts of the globe, you also see a couple of bullets that outline some of the drivers for us to take up this work and try to bring transparency forward in this area. One, as I've already briefly indicated, that is of course very important, is that in particular wealthy individuals often as part of their investments have real estate in foreign countries. I mean, this can of course start with more basic forms of investment, such as a holiday home abroad, or an apartment in another city. But it can of course also stretch well beyond that and include potentially very prestigious or expensive pieces of real estate, and indeed also sometimes even an investment component to it, in the sense of the semi-professional or professional investment in real estate with a view to renting properties and obtaining income from these investments. We have in the last couple of years, and some of these reports have also been shared with the G20. We have done research into the scope of this issue and whether this merits further work on the tax transparency front. And I think, as you may, for instance, see from the July 2023 report that we did on this subject to the G20, there are indicators that there is a significant share of undeclared assets and capital gains in this space, and that access of tax authorities to relevant information in this domain is far from ideal, and that therefore is a case to try to make progress in this regard. I think it's also as part of the preparatory work that we did, it also became apparent, and this is maybe unsurprisingly, that real estate is of course also an attractive alternative asset class to not be reported under the common reporting standard that we have developed now the best part, or even a little bit more than a decade ago. As most of you may know, the common reporting standard covers financial accounts with banks and other similar investment products in the financial sector, but it does not cover direct investments in real estate. And so one can see that if there is money that you would not wish to declare to your tax authorities, that one possible way of making sure that that does not happen is to move it from a financial account or a financial investment product that would be covered under the common reporting standard into a real estate asset that would not be covered by those automatic exchanges. I think there is, beyond the important dimension of trying to detect cases of hidden wealth and tax evasion, there is, of course, also a dimension here to this work to improve compliance and make compliance more efficient. It's of course also useful for those taxpayers that want to be compliant, that countries proactively share relevant data with each other, so that ideally that can be immediately taken on board of a tax return. Some countries are even able, on the basis of such information, to pre-fill tax returns and make sure that amounts get declared. And that's of course also certainly a benefit that you could see here, to make sure that that this income and wealth for those countries with a wealth tax is appropriately brought to taxation. As I said, it's probably part of the last point here. Tax administrations generally benefit from better access to data. Automatic exchange policies generally have the tendency to reduce the need for incidental, unstructured requests for information, and make sure that tax administrations can focus their efforts on cases where it really matters by having a good baseline of data. And that's, of course, also something that we're trying to achieve here. So now that I have set out why it matters, it's maybe the moment to explain a bit to you more concretely what we are currently doing on the basis of the next slide. So, as I've already indicated, we are currently working on an international exchange agreement for real estate, for automatic exchanges of real estate information. This builds on the interest that the G20 has expressed on a number of occasions in recent years for us to explore this work and move forward with possible solutions in the area of transparency for real estate. And so the framework that we are currently designing works on the premise that participating jurisdictions will exchange information that they have readily available and that is of good quality with each other on an annual basis. The idea behind this is that we believe we can make short-term progress in this field by accepting that countries may have different structures nationally where real estate information is captured. So this, of course, begins with real estate registers, but it can also go across other ownership registers that countries may have. And of course, tax administrations quite frequently also sit on relevant information on real estate, for instance, because of stamp duties that need to be paid and declared. And those, of course, indicate typically the value and the owner, as well as tax return information from the declaring of recurrent income or other relevant taxes due. And so we think that if you combine this information in an intelligent manner, that actually we have in countries good data sources available that are relevant for other jurisdictions for automatic exchange. So how does this concretely work? We have designed this framework in the current stage as a modular framework, which works on different blocks of information potentially being collected and then exchanged. They cover four types of information that you see here on the slide. Maybe in turn, and I appreciate that this doesn't follow the order of the bullets, but maybe for the explanation it's helpful. So firstly, we are looking into a one-off exchange of existing holdings. At the beginning of the agreement being in effect, the idea there is that this will help jurisdictions in relation to their taxpayers to understand who currently holds an asset in another country. And through that, we hope that tax administrations can paint a picture of how the situation currently looks. And then going forward, and so going to the bullet just above, there would then be an annual exchange of new acquisitions in a given year, new disposals in a given year, and also the recurrent income that is being realized from real estate. And so with those different components together, our hope is that a picture can be painted over time that allows tax administrations to understand what real estate assets are being held abroad by their taxpayers, but also, of course, very importantly, what income, both capital gains income from disposals and recurrent income, for instance, from rental, are being earned. I should also say in this regard, I think it's quite important to understand that the basic premise, of course, for these exchanges is that the country where the real estate is located identifies the jurisdiction of residence of the taxpayer, and then exchanges that information specifically with that jurisdiction of residence. So this is, of course, I think a basic feature in exchange of information, but that would also apply here. That of course we try to make sure as part of this framework that the information travels to the residence country where the taxpayer has a comprehensive tax declaration obligation, so that it is that country that can do the necessary compliance work. This framework is expected, once finalized, to be open to all countries and jurisdictions that are currently involved in the Multilateral Convention on Mutual Administrative Assistance in Tax Matters. The agreement that we are drafting would be a competent authority agreement, a multilateral competent authority agreement under the terms of the convention. This is very much the same thing as the work that we have done for instance, automatic exchanges of common reporting standard information, country by country reporting information, or more recently exchanges in relation to crypto assets under the crypto asset reporting framework. Of course, thankfully the participation in the convention is very wide. We're still one jurisdiction short of the magic number of 150, so we're currently on 149, but we hope that we can cross that line this year. I'm moderately confident, so that shows, of course, that this is an agreement with a very wide geographical range, where hopefully this information could be available to a broad range of interested jurisdictions. Currently, and of course, as I said, there is still technical work to be completed in the relevant OECD working party in this regard, but our aim is that we can put ourselves in a position to launch this work by the middle of this year, so in the next couple of months. Then maybe finally, before handing back to Philip to speak a bit more about our work in respect of digital platforms, a final slide on what could be the key benefits of this initiative when it is launched and when it hopefully gets a large geographical reach. Well, obviously, it will allow structural access to real estate information to facilitate compliance by taxpayers in their jurisdiction of residence. I think also very importantly, this information would travel in a pre-agreed, clearly structured electronic format. That is, I think previous initiatives have proven that extremely important for making sure that a tax administration that receives this information can also make good use of it, so that it can be easily integrated into the databases of a tax administration, and that compliance activities can be deployed efficiently on that information. And that hopefully will then also help in increasing the capacity of tax administrations to detect offshore income and hidden wealth in the form of real estate, and make sure not only that recurrent or future capital gains income is adequately taxed, but also to make sure that the wealth that has been used to acquire the real estate in the first place was declared, and where required has been appropriately brought to taxation. And then finally, and this is maybe saying really the obvious, but I think it is an important aspect. Of course, if such an initiative where we would try to automatically exchange real estate information on a annual basis, is also expected to be a deterrent against not declaring foreign real estate, and hopefully will also help to make sure that those taxpayers that currently are not compliant, or that in the future may consider not to be compliant in respect of real estate assets they earn abroad, to maybe make another choice and declare these assets and this income from the outset. So I think that's in a nutshell the work that we're doing in this space. I should of course say, but I'm sure that we will repeat that still on an occasion or two. If you have any further interest or questions about this work, of course, feel free to reach out to us. We're happy to provide further background and guide you through the process that we are undertaking to deliver this framework. So I think with that, now back to Philip.
Moving on to our next area of priority, which is increasing the reach of our automatic exchange of information on digital platform income. As mentioned, this is an initiative that has already started a couple of years ago. And the reason why we started this project was that there has been, of course, a very significant growth of the digital economy. And perhaps if we can move to the next slide, over the past decade. And that has transformed the way taxpayers, both individuals and businesses, can make their income. This has in particularly led to an enormous growth of the so-called sharing and gig economy. Everybody will know the examples of the rental of rooms or apartments through platforms such as Airbnb, or the provision of household services or personal services, or transportation apps, ride-hailing apps such as Uber. And this phenomenon has actually created some opportunities and challenges for tax authorities when it comes to tax compliance. Opportunities because often before the existence of these digital platforms, a lot of these activities were taking place in the informal economy, and were not on the radar of the tax authorities. And now, with the arrival of all these digital platforms, it does mean that information on that income sits somewhere in digital form in the hands of these digital platforms, which creates interesting compliance opportunities from the perspective of tax administrations. Now, the challenges are twofold. On the one hand, often the taxpayers do not know really whether that income that they earn is taxable through these platforms, and that creates unequal level playing fields between those that derive income through these platforms and those that derive income through ordinary employment contracts, and that increases the non-compliance. But the most important challenge for tax authorities seems to be that in most instances these platform operators are based outside of their jurisdictions, and it is very hard to get access to this information or to enforce obligations on these foreign platforms to provide that sort of information. And it's against that background that we have adopted this framework for automatic exchange of information on income derived through digital platforms. And next slide, please. We developed this framework already, I think, in 2020. It's a framework that looks very familiar to those that are familiar with the CRS. It's composed of 3 building blocks. There is a set of model rules that can be implemented by interested jurisdictions, and these model rules are designed for these jurisdictions to collect information on the income received from platform sellers from the platforms that are located in their jurisdiction. And so this achieves in some form of standardization. We thought that one of the benefits of this is that it would prevent a multiplicity of different reporting requirements in different jurisdictions, which would make it much more hard for these platforms to comply. So this is one thing. These rules would then be adopted by implementing jurisdictions, and then we also developed a multilateral competent authority agreement that is again an agreement based on the multilateral convention. And that multilateral competent authority agreement is designed for the participating countries to exchange automatically on an annual basis the information that they have collected from their platforms with the countries that have a tax at stake with respect to the income, and this includes the countries of residence of the platform sellers, and also the countries in which immovable property is located that is rented out through these platforms. And then the third component of this framework is, as usual, an XML schema to make sure that there's a streamlined and standardized reporting and exchange of this information amongst participating countries. So the entire model is based on collaboration. Countries collect information from their own platforms. They are better positioned to do so. They can better enforce compliance from their own platforms and share it with those countries that need it. And then maybe if we move to the next slide, we think that there could be tremendous benefit for countries to join this to join this framework. As I mentioned, it is very hard. We see that very hard for jurisdictions to enforce reporting obligations on foreign platforms. For most countries, these platforms are not based in their jurisdiction. We have currently 29 jurisdictions that are participating in this framework, and that includes jurisdictions that are hosts of the most important large digital platforms such as Airbnb and Uber and Booking. And it seems to us that it's a more attractive proposition to participate in this international cooperation to get quality information from the jurisdictions where these platform operators are located than trying to get the information directly from those platforms. Other benefit of this is that this is just like the framework that we are building for automatic exchange on immovable property. It is open to all participants in the multilateral convention. So this is not limited to OECD members. Anybody who is participating in the convention can join this framework. We believe that a big benefit of joining this framework is also that it can be implemented at limited cost, and limited cost for countries, in particular for countries that have already implemented the CRS or CBC, who are familiar with this architecture, because we use the same architecture for this framework. Exchanges happen through XML and using the common transmission system that is also used for the other automatic exchange programs that are out there. It's not only it has cost benefits for the countries, but also for the platforms. because if you compare the situation for a platform operator between having to implement a ad hoc unilateral new reporting regime in a specific country, or adding a country to these to the existing systems for implementing these rules, it's a different proposition. It is very easy for the large platform operators to add another country to those rules, whereas it's very costly and burdensome to have to implement an entirely new reporting regime and to have different reporting requirements in different jurisdictions. So most of the large platforms are active in the countries that have already implemented those rules. And so for them, it is just a matter of adding another country to these reporting systems they have in place if a new country is joining the system. On that note, I think I will hand over to Paul to talk about technology and the work we are doing in this area.
Thank you very much, Philip. Yes, indeed, a last topic that we would like to present to you and give you a bit of an overview over is what I guess you could summarize in the shortest possible way as tax and technology. I think many of us will still remember the days where tax returns had to be done on paper and had to be sent to a post office box, and then you would typically get a paper assessment after a number of months. But of course, the world at large and also the world of tax administration has moved on and is moving on increasingly. And that, of course, also leads to certain questions and opportunities for the work that we do on the tax transparency front with as overarching team. What can we do to make maximum use of technologies that are available to make this work more efficient and work better for everyone. And maybe with the next slide, I can give you a bit of an overview of the dimensions of the work in this context. So here on the slide, you see 4 dimensions of how we think tax and technology can bring the tax transparency work forward. Maybe starting on the top left with the notion of reliance on digital identity verification. I think if you look to the current automatic exchange policies that we have developed, starting with the Common Reporting Standard and then going to the crypto asset reporting framework and the digital platform rules that Philip just spoke about, they all have in common that they operate on the basis of due diligence procedures where information on the relevant taxpayers gets collected by the intermediary that needs to report. So in the context of the Common Reporting Standard, that would of course be the banks, the insurers, the investment entities. In the case of crypto, that would be the crypto asset service providers. And in the case of the digital platform reporting, those would be the platform operators. And they all collect customer information, typically a combination of paper documentation and a paper or electronic self-certification of tax residence to confirm where a taxpayer is resident, so that then the relevant information on financial accounts, crypto assets, or platform income can be shared with the tax administration of the jurisdiction of residence. And I think if you ask the relevant intermediaries what is the major burden in terms of operating these automatic exchange of information standards, the answer that you would likely be getting is, well, we have to run all these compliance and due diligence procedures to identify who needs to be reported to which jurisdiction and make sure that everybody is and remains properly documented. And so one technique that potentially in the evolving technological landscape could help to make that easier would be a fully digital identity verification method where, for instance, based on a standardized electronic set of information, be it in the form of a token or a unique identifier issued by the resident tax administration, a person could be identified in a very simple manner with an intermediary without that intermediary then needing to rely on its own often paper-based due diligence procedures that, as I said, can potentially be quite resource intensive. So this is certainly an area that we have an interest in to explore what can be done there, because it has, of course, two advantages. Firstly, it makes the due diligence procedures a lot easier and a lot less in need of resource intensive procedures. On the other hand, it also, of course, helps tax administrations and taxpayers in making sure that the right jurisdiction of residence gets identified, the right taxpayer gets identified, and that this information can be used in a very efficient manner when it then gets received through exchange of information. On a similar note, now in the green box on the top right, there is also, of course, the aspect of the timing of exchanges and how closely does that link with the domestic tax compliance procedures in different countries. Those of you that have experience in for instance, CRS or CARF exchanges will know that typically the exchange timelines that are foreseen in those frameworks are about 9 months after the end of the year to which the information relates. And so that then, of course, means that typically information, say, for instance, in relation to 2024, would only reach a tax administration by September 2025, which then is typically after the filing deadline for the tax return, so that this can only be used as a after return compliance instrument. And it would, of course, be much more attractive in a certain way if the information could already be pre-populated before a taxpayer files the return, to make sure that the information can be used immediately when taxes are being declared and first assessed. And so that's, of course, a question: what can we do to make timelines shorter? How can we make sure that systems help us, that information can travel more quickly, potentially at lower intervals, if provided, of course, that this information is structured and can be generated in a manner that is efficient for these purposes. So that's also on the tax and technology front, an area that we are exploring. Then maybe now moving to the bottom left, the purple box, the direct access to repositories dimension. As I said in the explanation of the real estate work, I think one of the points that came out of the research and the exploration work we did before we started designing the framework itself was that actually a lot of information is sitting in data repositories, such as, for instance, real estate registers or other ownership registers. That is potentially very useful and very relevant to tax administrations, but that typically this information does not get into the hands of a foreign tax administration either at all or not in an efficient and calibrated manner that would be useful for tax compliance purposes. And so I think under this header, we are exploring whether there are models, ideally within the existing international legal architecture, that could be deployed to improve access to data repositories where such information is relevant for a foreign tax administration, so that we can make better use through these kind of policies of information that is already available, but that is just sitting in the wrong place at a given moment in time in terms of being helpful for tax compliance purposes. So that's certainly also a work stream where we think that linking that up in an intelligent and relevant manner could potentially be very interesting for improving tax compliance in certain areas. And then finally, on the bottom right-hand side of this slide, this is something that you will see quite frequently in OECD settings, unfortunately. There's, of course, an acronym. So maybe I should decipher the acronym first. So the FTA stands for the Forum on Tax Administration, which is a body that we have where over 50 tax administrations come together to discuss relevant areas of tax administration and how that can be improved by sharing their experiences and undertaking projects together. And as part of that work, there is what is known as the Tax Administration 3.0 agenda, which is looking into how tax administrations can be streamlined, be made more efficient with the help of technology and, of course, in particular, IT. And there also we are, from our perspective, actively helping colleagues in that regard, supporting that work by looking into how exchange of information, tax transparency initiatives, and technology to transmit information can help those efforts in making tax administrations leaner, faster, and fitter for the future. So that's also a dimension that we are very interested in developing work in that area. I'm very conscious of the time and that we're getting close to the 4 o'clock mark. I think we have taken you through the items that we wanted to set out to you in terms of our current work and also potential new areas of work that we could consider undertaking. I hope it was helpful, but maybe before closing, I briefly hand back to Philip to see whether he has any concluding remarks. But if I don't speak again, I would already like to thank you for your interest. I hope it was useful. And as I said before, very happy to get in touch if there are points that you would like to further discuss with us.
Thank you, Paul. And I don't know, we have still 10 minutes. I guess if there are any questions, we could perhaps still take those. We'll have a look whether there are any hands going up. I see no hands. So in that case, I can only thank you for your interest in this session, and to reiterate that should you have any interest in joining the frameworks that we've been talking about, whether that be real estate or digital platforms, do not hesitate to reach out to us for further information. Thank you very much.
Philip, sorry for interrupting you literally at the last second, but I realized that we have 2 questions in the chat that we may still try to answer. I think there is one question that I think is probably difficult for us to answer. The question is how many rulings are being exchanged within the EU under DAC 3. I think that would indeed be a question more for our European colleagues to answer that. I think in our framework, the rulings between all inclusive framework members that we have identified have led to 58,000 exchanges in total. And so that's the overall number, and I don't think that we immediately would have an EU-specific number available, but I'm sure that information could be procured from EU colleagues in that respect. And I think another comment from one of our colleagues from Guatemala in terms of the work on the platform operators and those aspects. I think it's more a question of follow up bilaterally in terms of what could be done there. So maybe we'll leave that for bilateral conversation. But those were the 2 points I just wanted to mention that we saw them. So thank you for raising them, and maybe with that, I guess we can conclude our session and hope you enjoy the other sessions that are still happening today.
Thank you very much.